Hi guys, welcome back to UK Stocks with Anna. Today we're going to have a look at 3 stocks that recently had their smart score updated to 10 out of 10, which means that they are likely to outperform the S&P500. So we'll have a look at them and see what you think of these. I think that 1 out of the 3 is definitely a buy for me personally, but the other 2 I'm not so sure of. So I would love to hear your opinions in the comments. But yeah, let's jump straight in. I'm actually going to order these from worst to best in my opinion. But yeah, let me know if you disagree or if you have any other opinions. Also, I do apologise for my voice. I'm still extremely ill, but I couldn't put off making this video. So yeah. So the first stock we're going to look at is Capita, ticker symbol CPI. Capita is an international business processing, outsourcing and professional services company. It is the largest business process outsourcing and professional services company in the UK, with an overall market share of 29% in 2016. It has clients in central government, local government and the private sector, and it also has a property and infrastructure consultancy division, which is actually the 4th largest multidisciplinary consultancy in the UK. Roughly half of its turnover comes from the private sector and half from the public. And whilst they're UK focused, Capita also have operations across Europe, Africa and Asia. They were founded in 1984 and they are a constituent of the FTSE 250. So smart score, like I said, it's a 10 out of 10, and we can see here that everything is pretty green with the exception of asset growth. So analyst ratings, moderate buy, blogger opinions bullish, technicals pretty positive, return on equity very positive. It's just the asset growth. So if we have a look at the analyst ratings, there's only 1. So this is the only issue I have with this one at the moment, is that there's only 1 analyst rating and it was 2 months ago. So 71% upside, which is huge, but it was 2 months ago and all the rest are very old. So price target of 80 compared to a current price of 46. So a fairly cheap stock, because 46p for a stock is actually very, very cheap. You could potentially even consider it a penny stock, because I think penny stock is under $5. If we have a look at the stock chart, we can see here that it's really interesting. They don't really seem to be doing that well so far. So they seem to have a big downward spiral from 2017, then a big crash in 2018, have kind of plodded along since. So until 2020 when they crashed again, and again have just been plodding along since. So the question is, are they going to come out of it? Are they going to, you know, go back to the previous levels, in which case, yes, there could be a huge upside potential there. But if they're not, is it really going to outperform the S&P 500? If we have a look at the news section, the one that catches my eye is the selling of the unit here. So as you can see here, if we go into this and get rid of all the annoying adverts, Capita has sold its secure solutions and services business to NEC Software Solutions for 62 million. So a pretty decent cash injection for them here, providing everything goes through smoothly. It's an interesting one with Capita because they do have a lot of really high-end clients, but that hasn't stopped companies from going bankrupt in the past. So it's one I'm really on the fence with, and I personally won't be investing in it, but I'd love to know what you think. The next stock on the list is Legal & General, ticker symbol LGEN. So Legal & General is a British multinational financial services and asset management company headquartered in London. Its products and services include investment management, lifetime mortgages, pensions, annuities and life assurance. It has operations in the UK and the US, and investment management businesses in the Gulf, Europe and Asia. They are listed on the London Stock Exchange and are a constituent of the FTSE 100, and their asset management arm is the 10th largest investment management firm in the world by assets under management. It is also the 2nd largest institutional investment management firm in Europe, second only to BlackRock. and they were founded 185 years ago. They also pay a pretty neat dividend of about 6%, so they are a really good dividend stock to hold. So Smart Score is 10, as I said. Let's have a look at the analyst ratings. So better than the last ones. We have 8 here, 5 say buy and 3 say hold. Now the price targets have an average 18% upside here, but the lowest price target here is lower than the current price. Not by far, but it is. Now, the latest ones do seem to be all a buy with quite decent upsides, and the downside actually seems to be from 2 months ago. So a little bit of an older one, whereas here we've got that 40%, the 30%, etc. If we have a look at the stock chart, we can see here that actually they are pretty much at their all-time high. So they seem to obviously have dropped as everything else did in 2020, but have recovered swiftly and have pretty much outperformed themselves to where they were before. If we have a look at the news, this one catches my eye. So Legal & General Group's underlying earnings growth outpaced the notable return generated for shareholders over the past year. So if we click into that one, you can see here that the Legal & General Group share price is up 49% in the last year, clearly besting the market return of about 22%, although that wasn't including dividends. So if it can keep that up, investors will do very well. Now the longer term returns haven't been as good, with the stock price only 2.5% higher than it was 3 years ago. Bearing in mind though that we've had the massive crash in 2020, so they've had to dig themselves out of that. Now if we look at the analysis in this article though, it does seem like the sentiment is quite cautious, which you can see in the fairly low PE ratio. So again, worth doing your own research on this one. I personally hold Legal & General, and I probably will be adding to my position. I do think they are a really solid company personally, and they are a good dividend payer, but make sure you do your own research. So the final company on my list is one that we've mentioned many times before, and that is Greggs. Now, if you haven't been here before and you haven't watched my videos, then I will just remind you what Greggs is. Greggs is a British bakery chain that specialises in savoury products such as baked sausage rolls, sandwiches and sweet items like donuts, vanilla slices, etc. It was founded 82 years ago and is also a constituent of the FTSE 250. So Smart Score is 10 again, and analysts are showing a moderate buy. Pretty much everything is green here with the exception of that asset growth again. But once again, you know, they had a difficult 2020 being shut and everything. So if we have a look at the stock chart, we can pretty much see that they are trading at almost at their all-time high. They have climbed out pretty well since 2020. So we can see here that they had that massive drop in 2020, and then pretty much since September, they've been steadily climbing. So if we have a look at those analyst ratings, we've got 4 here. 3 say buy, 1 says sell. But again, the lowest price target here is higher than the current price. So pretty much still an upside either way. But the average upside does seem to show only about an 8% upside. Now, if we have a look down here, we can see that the sell rating was 5 days ago, but it has no upside or downside and no price target. So to me, I would personally probably just disregard that because it doesn't really seem very serious. And finally, let's have a look at the news. So the first one really catches my eye here. So shares in Greggs saw as staycations and new vegan treats help drive sales above pre-C levels, despite the supply chain and staffing issues. So we do have a lot of supply chain and staffing issues in the UK at the moment, but we can see here that they are doing fairly well. So if we click into it, we can see here that their third quarter sales in company managed shops were 3.5% up on 2019 levels. They revealed their plans to double their turnover by 2026 and to add 150 more stores per annum. They said that trade was particularly strong in August, when millions more Britons were taking domestic holidays due to travel restrictions and uncertainty, but that business remained very healthy into the start of October. So I do hold Greggs personally, and they are actually one of my top performing stocks in my own portfolio. I did get into them quite early on in 2020 though, so that's potentially why, but I invested in them because I love the company and they are literally on every major UK high street. So I believe in them long term. But yeah, anyway, that's it for today. Hopefully that's been useful and it's given you something to research and think about. And yeah, thank you for watching and don't forget to subscribe. Bye.